The GRI Africa Regional Conference is brought to you by GRI, developer of the world's most trusted and widely used sustainability reporting standard, with support from the Swedish International Development Cooperation Agency.
Hello and welcome to the special CNBC broadcast from the Global Reporting Initiative Conference in Johannesburg, South Africa. The issue of sustainability is increasingly gone up the agenda of boardrooms. 15 years ago, sustainability was an issue on the back burner. Increasingly, it's being seen as an issue of risk. How do companies ensure that they are sustainable, not for today's shareholders, but for the stakeholders of the future? It's a big discussion. It's an important discussion, and we've got people from across the African continent, from global experts to local experts, and it's a really interesting discussion. Do stay tuned, come inside and have a look what it's all about.
The Global Reporting Initiative Africa Regional Conference, the first of its kind in Africa, recently took place in Sandton, Johannesburg. Key dignitaries from across the continent and the world gathered here to share knowledge and evaluate ways in creating sustainable, transparent practices among private and public organizations.
Why the need for it is, you would know, Africa, these are exciting times for Africa from an economic perspective and also from a democracy perspective. There's growth in democracy on the continent, transparency and accountability, taking center stage in many activities, an active citizenry which is interested in the governance of resources that are obtaining in their areas, and they also expect to benefit from those resources obtaining in their areas. So it's about shared value, if I may put it that way. What are the communities? What are the other stakeholders benefiting from the exploitation of resources in their countries? And what is the role that the corporate sector can play in pursuing economic growth as well as social growth in Africa?
These practices are known as integrated reporting or sustainability reporting. The GRI has been operating in South Africa for 2 years under the leadership of Douglas Kativu. Corporate governance was revolutionized right here on the African continent in South Africa. Former judge of the Supreme Court, Mervyn King, was tasked with chairing the King Committee on Corporate Governance. The committee issued 3 reports in 1994, 2002, and 2009, endorsing an integrated and inclusive approach to corporate governance in South Africa. The 2009 report, known as King 3, has since set the global standard for corporate governance practices. A chief recommendation contained in King 3 is integrated reporting, which has been adopted as standard practice by the Johannesburg Stock Exchange for listed companies.
In my judgment, financial reporting is critical, but on its own it's not sufficient. And that is clear from an analysis of companies listed on the great stock exchanges of the world, that 80% of market cap is not represented by additives in a balance sheet according to financial reporting standards. So that's made up of so-called intangible assets, like the reputation of the company, the quality of its governance, the quality of its risk management, how the company actually makes its money. So these things are critical. The sustainability report is critical. But from a management point of view, on a daily basis, you and I managing the business of a company deal with human capital, natural capital, intellectual capital, the relationships with our customers, other stakeholders, they're all integrated and interconnected. And so to report just in silos is not reality. So an integrated report is taking the critical information out of the basket of sustainability issues, the critical information out of the basket of financial issues, and taking them up not in International Financial Reporting Standard language, which is incomprehensible to 99.9% of people, nor in GRI language, which has become very difficult to understand, but in clear, concise and understandable language, so that the reader, the user, can make an informed assessment about the state of play in the company and whether this is a business that's going to create value creation short, medium and long term.
Although a new concept, integrated reporting is fast becoming an enabling, necessary practice for companies to continue doing business in a rapidly progressive society.
What companies are starting to realize is that reported information and the process of reporting actually gives them a deeper understanding of a lot of the challenges that they as an organization face and the issues that they're managing. There's a very different approach to managing an issue where you have hard data or you have a process that requires you at certain inflection points in the year to review. So how have we done against this? What's the target? Have we met the target? And that's just normal business management thinking, really, and proven. What you don't measure, you don't manage. So I think applying that thinking to a range of issues that were often thought of as quite soft, a little bit outside of the mainstream, has given companies a greater understanding that they're anything but soft. We often refer to them as non-financial issues, but indeed they're very financial. If you have an upset community that prevents you from manufacturing or producing or extracting a mineral, if you're a mining company, that's costing you money on a daily basis, both to manage, to the delays that you experience, etc., etc. So these broader issues, as reflected typically in a sustainability report, are really a kind of means of the company focusing in on those issues, on the key issue, the key aspects. What should they be doing about it? What are they doing about it? How have they done? So I think the big change in sustainability reporting that has come over the last couple of years has been, it's not just this huge effort, and it is a huge effort, to produce a report and then go, whew, done that, report delivered. It's really now moving into a phase where people are analysing the information much better for their own purposes, firstly, and secondly, for the purposes of having better types of conversations with their stakeholders, whether those are shareholders, potential investors, potential suppliers, potential purchasers of their goods and services. So it really then moves away from simply a reflection of what you've done to an enabler of conversation, an enabler of trade.
But concerns have been raised as to whether achieving a significant level of participation among companies globally is tangible. Integrated reporting is not enforced by legislation.
The word compliance is something that I'm not comfortable with, because it connotes that you have to do it. It connotes that it's comply or else there's some kind of sanction. Now, I believe, unfortunately, that's one of the problems in our state-owned enterprises, because they have to comply with the Public Finance Management Act, which deals with all the governance issues inside state-owned entities such as Eskom, Transnet, etc. Now, as soon as you have a comply or else, and usually there's a criminal sanction, and the PFMA has a criminal sanction, then in the nature of people, they'll make sure there's a compliance, and they spend a lot of time on complying instead of focusing on their main job, which is to make sure there's performance. So they spend more time on conformance than performance. And you actually get what I call the corporate sin of sloth, because you're not really doing your job. Now, you can't blame those people. So they might develop even a spreadsheet of things, and then you get what I call a mindless quantitative compliance, just ticking the boxes. The critical issue about good governance is the quality of that governance. How directors and management have honestly applied their minds in the best interest of that entity.
Shared value is also as relatively new a concept as integrated reporting. In essence, it refers to companies looking to build value not just for their business, but for broader society as well.
At the biggest level, shared value is actually a growth strategy. It is a growth strategy that is particularly pertinent in markets where you have these social challenges or environmental challenges, changing the nature of the opportunities and the risks and the level of volatility that companies are engaging. So shared value in itself is a response to the opportunities to expand your revenues, to reduce your costs, and to have a better response to the volatility in those markets. So a shared value strategy has got a lot of shared value initiatives, and shared value initiatives are really the engine of what drives the shared value strategy.
Referring to global and emerging markets, Robin says that in her experience, she has seen a shift in mindset by corporates towards shared value initiatives.
It's really important that organizations recognize the kind of boxes that need to be ticked in the space. So I don't want to underplay that and say that it's not important to do some philanthropy, to say that it's not important to make sure that you deliver on the metrics that, for example, your investors might be interested in the environmental space. This is important. But this is not ostensibly what we're talking about when we're looking at shared value. Shared value is on top of that. Shared value is about growth. Shared value is about increasing your revenues because you're accessing a new market at the base of the economic pyramid. Low-income people may not be a market you're in, but you need to access those people with a different kind of innovation, with a different strategy. The strategy and the innovation that informs your business in that market must be different. It can't be business as usual. It has to deal with the kind of social challenges that we face. Now, organizations could just say, well, let's try and avoid those social challenges, or they can say, let us use the scale of our business and the intelligence of our innovation to address those social challenges at the same time as increasing our access into the market. So it becomes a dual strategy where you're significantly linking the revenues, so literally the profit formula, to the delivery of measurable social value.
Theo Botha is a shareholder activist taking companies to task on their practices, including corporate governance, ethics, black economic empowerment, and environmental practices. In his experience, he believes companies have yet to shift their mindset towards integrated reporting and shared value initiatives.
I don't think they're making it part of their day-to-day business. I think the bottom line for listed companies is making profits, paying dividends, and hopefully that the share price will rise. Your asset owners and asset managers who are supposed to be holding these companies to account are actually forced to look at everything, their investments, in terms of a short-term basis. And why are they forced to look at it from a short-term perspective? Is because they get funds, and if they don't perform, then those funds will be withdrawn from them and they will be put with another asset manager who would perform. So the whole thing's skewed. But I think that there is a role to play for a fund manager that can actually look at your ESG issues and look at investments on a long-term basis and not on a short-term basis. And I am in the process to try and actually put something together in terms of asset management where we're looking at investments on a long-term basis, but holding companies to account. You don't have to hold them to account in annual general meetings. But when you hold companies to account and you address small little issues, those small issues actually balloon and they become bigger issues. Raising issues on environmental, social, and governance issues actually helps you identify risks, which maybe your audit committee might not have seen. So it's not just some harebrained idea that we should worry about, our environment and our society. We should not be producing profits at the expense of environment and society.
We're going to take a quick break from the GRI conference. We'll be back in just a moment with more of the innovations in sustainability reporting and also what this does to Africa's developmental agenda. Welcome back to the GRI conference in Johannesburg. Let's shift our focus now and look at the very important issue of sustainability, particularly on the African continent.
Africa as an emerging market is fast growing and ever changing. This year, member countries of the United Nations will produce a set of Sustainable Development Goals, or SDGs. These goals will shape development priorities for the future.
Doing business in Africa, I guess, is like doing business in any other market. You need to understand your market, you need to understand the investment. So you need to do due diligence, understanding the context of the market or the sector that you're wanting to get exposure to. I think unfortunately Africa has been branded with certain generalizations. Certainly international investors are very cautious, but I think investors are by nature cautious. Where there's risk, there needs to be reward for that risk. So I think South Africa, in my view, has been, and indeed Africa has been moving forward. We've got fantastic growth rates in some of our neighboring countries, and that's because there's rising investor confidence. One is starting to see companies disclosing more, especially for international investors who may be a little bit more risk averse or don't understand the African way of doing business.
Despite Africa's phenomenal growth story, doing business on the continent still has its challenges and risks. These challenges persist as barriers for companies to participate in integrated reporting. Perhaps also deterring companies from fully committing to integrated reporting are the costs of implementation that may affect the bottom line.
The cost of producing sustainability data, firstly, and then reporting it is substantial. But in the scale of the potential costs and consequences of not understanding those aspects of your business, it is not sufficient reason not to report.
Monique van Zyl is the project lead of Oxfam's Behind the Brands initiative. Their focus is on the world's 10 biggest food and beverage companies who are sourcing agricultural products from the developing world.
About 2/3 of commodities are coming, we know, from smallholder farmers around the world, and we also know that there's massive resource concentration in the food system. So fewer than 500 companies control 70% of the world's food choices. We also know that in the world, 1 in 8 people go to bed hungry every day, despite the fact that there's enough food. So working for Oxfam, what we're really trying to do is ask what's wrong with that food system and how we can address it. We do this through a scorecard, which looks at 7 different social and environmental indicators for these big 10 companies. So issues like water rights, land rights, the way they treat women in their supply chains, workers, how transparent they are in terms of corporate governance, but also tax. And really get them to try and, climate change is another one, really get them to try and move forward in a race to the top as big companies to improve sustainability, and both because they own a number of iconic brands, but also because they have sheer market volume in this highly concentrated global food system. We hope that they can set a new standard in companies taking responsibility for their supply chains. And we do that, one, through sharing our research with them and deeply engaging with the companies, but much more importantly, we honestly believe that no company is too big not to listen to its consumers.
But do these companies value the comments and suggestions put forward by Oxfam?
The campaign is 2 years old, and we've had incredible success and really, really good traction with the companies we've been engaging. So across all 7 themes, you've really seen them start to progress across the board. Obviously, they have a long way to go, and despite having made a number of strong policy commitments, what we're now doing is really discussing with the companies how to really walk the talk and how do you implement these in practice. The response from the companies has been varied. And also the response within the companies. So there are a lot of strong departments in the number of companies who are looking at sustainability issues, the CSR departments, or individuals who really, really believe in these issues. And that is very different from those colleagues often who are in procurement or in purchasing and who have to sell a business case for the strong commitments and the costs that are involved sometimes in implementing these standards.
Southern Africa's mining sector is constantly under fire for labour, social and environmental issues. Cloud Kapemba is the executive director of the Southern Africa Resource Watch, a human rights organisation. Their focus is on reconciling the abundance of natural resources with the abject poverty that continues in Africa. He shared his views as to how mining companies can transform the industry.
I think if you are a smart business, you must know that your protection for your investment lies with the host community. We've seen where the risk has turned into crisis, that communities have come against mining companies, and this is not just in South Africa, but across our region. So it's paramount for a smart company to invest in communities, but investing in communities does not always translate into positive result. It means companies have to work closely with communities. Companies must be accountable and transparent in providing information, in working with communities to identify the needs of communities and how communities will prefer that investment to be done. Most of the time what we see is companies doing things for communities, and that is not a good model of community investment. We are seeing companies investing depending on their capacity, but those investments are not producing or changing the image communities have about them reaping and taking without investing in communities. So there is a contradiction, and that the tension that companies need to resolve. And we are saying for a proper and positive social investment, it has to involve communities, and these communities have to be given space to engage in an open space and identify their own needs, and not even to be given the space to do this themselves, their own investment. So we are seeing new model where companies are putting up community funds, and the communities are allowed to start thinking on how to grow that community fund and which sector to invest.
If we look at the evolution of business over the past decade, it appears the trend is headed towards integrated reporting and shared value becoming standard and perhaps one day legislated practice, where it's no longer about who is leading the way, but how they're doing it, where it's no longer about how much profit you're generating, but about how you're uplifting your community and your environment, and where it's no longer about meeting your responsibility, but about why your responsibility matters.
The first trend that I think we're going to see is that there's going to be much more demand from companies on their suppliers all the way down the supply chain to really have the same level of reporting. Before, a few years ago, companies were really looking at their own operations, and now you're seeing companies applying their policies to their suppliers, to their franchisees, to their licensees, so much bigger change. I think it's very challenging for companies, especially the big companies who do have strong policies, to get that reporting in from their suppliers, but also to be able to influence them because they're buying small volumes of the overall trade. What you will see is that there's more transparency, and as companies begin to report more on their own operations and that of their suppliers, I think you're going to see a lot more pre-competitive collaboration. So where you'll get groups of buyers getting together and saying, these are the standards that we want to see, and specifically in multi-stakeholder initiatives. So I think you're going to see a lot more collaboration between civil society, between governments, between companies coming together to deal with big issues together in a sustainable way.
The only time that we'll see a shift in the mindset of companies believing in corporate social responsibility as part of their business, part of their core business, is when communities can demand and represent themselves and can engage these companies.
My advice to companies is to avoid what you initially called the ticking the box approach. That is not the idea behind sustainability reporting. That has never been the objective of GRI. The objective of GRI has been to empower change The value in sustainability reporting is in the process, what we call the process, the systems, the procedures that we put in place to manage significant environmental, economic, social risks and impacts, and also taking advantage of opportunities that are also lying within the sustainability space. So it's more about empowering decision making, first within the company and also in the relationships with stakeholders. It's not about just the rush to produce a report.
That's it from the Global Reporting Initiative in Johannesburg. Thank you so much for watching. It's been an interesting day. It has been a whole range of insights. Crucial to this process is the issue of trust. Stakeholders, different agendas, but ultimately what you realize is that everybody who is here today wants the same thing, and that is sustainability. But how do you balance that with short-term profits, with shareholder demands, with executive remuneration, and ultimately ensuring that the planet is a place where our great-grandchildren will thank us for leaving in better shape than we found it? Can we achieve it? Well, sustainable reporting, transparency is one way of going about it. Thank you for watching from the team here at CNBC Africa at the Global Reporting Initiative. Bye-bye.